Today, we're going to break down something that impacts anyone selling investments, property, or other valuable assets in Canada: capital gains tax. Whether you're selling stocks, real estate, or options, understanding capital gains tax can help you maximize your profit and minimize your tax bill. Welcome to the channel. My name is Eric Selvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. What exactly is capital gains tax? Simply put, it's a tax you pay on the profit you made from selling a capital asset. If you sell something like real estate, stocks, or options for more than what you paid for, you've made a capital gain. In Canada, that profit is considered income, and you must report it on your tax return. But there's good news. You don't pay tax on the entire profit. Instead, you pay tax only on 50% of your capital gain. This is known as the inclusion rate. In Canada, the inclusion rate for a capital gain is 50%. This means only half of your profit is considered taxable income. The other half is yours tax-free. Let's look at a quick example. Let's say you're in the top bracket in Canada, which varies by province, but for this example, we'll assume you live in Ontario, where the highest combined federal and provincial tax rate for 2025 is 53.53% for your income over $246,000. Suppose you bought a stock for $100,000 and sold it later for $130,000. That's a profit of $30,000. At a 50% inclusion rate, only half of that, $15,000, is taxable. $15,000 is added to your income for the year and taxed at your regular tax rate. The remaining $15,000 is completely tax-free. Since you're in the highest tax bracket, your marginal tax rate is 53.53. So you'll pay $15,000 times that rate, which will come to $8,029 in taxes. A total gain of $30,000, taxes paid of $8,029, which is a final profit of $21,970. Another type of capital gain we can offset is from options premiums. If you trade options, the premiums you receive from selling call or put options are considered capital gains in Canada. The same 50% inclusion rate applies. For example, if you sell a call option and collect a $2,000 premium, half of that, $1,000, is taxable as a capital gain. The other $1,000 is yours tax-free. Keep in mind, if the option expires worthless, the premium is still considered a capital gain in the year it expires. All right, so we've covered how capital gains are taxed. But what if you lose money on an investment? That's where capital losses come in. If you sell an investment for less than what you paid, you incur a capital loss. The good news is that capital losses can be used to offset your capital gains, reducing your taxable amount. Here's how it works. Capital losses can only be used to offset capital gains. They can't be used to reduce other types of income, such as employment income, dividends, interest, or rental income. If your capital losses are greater than your gains for the year, you can carry those losses back up to 3 years to offset gains reported in the past. Alternatively, you can carry them forward indefinitely to offset future gain. Here's an example. Let's say you sold some stock and made a capital gain of $10,000 this year, but you also sold another investment at a loss of $4,000. You can subtract that $4,000 loss from your $10,000 gain, leaving you with a net capital gain of $6,000. At the 50% inclusion rate, $3,000 would be added to your income and taxed at your regular rate. If you didn't have any capital gains this year, you could carry that $4,000 loss back to offset gains from any past 3 years, or you could carry it forward to reduce future gains. This strategy, known as tax loss harvesting, is a great way to minimize your capital gains tax bill. Let's clear up a few common questions. Do I lose half of my profit to taxes? No. Only half of your profit is added to your income. You'll pay tax on the amount based on your income tax rate, and the other half is yours to keep tax-free. Is there a standard capital gains tax rate? No. The amount you owe depends on your total income and your tax bracket. Essentially, the more you earn, the higher your tax rate. Now, how can you reduce the amount of capital gains tax you pay? Here are some strategies. Hold investments in tax-sheltered accounts. Investing through registered accounts like RRSPs or TFSAs lets your investments grow without being subject to capital gains tax. Offsetting gains with losses. As we just covered, you can use capital losses to offset gains, reducing your taxable income. Principal residence exemption. If the property you sold was your principal residence, the capital gains are exempt from tax, provided you meet the necessary requirements. Understanding capital gains tax isn't just about knowing how much you owe. It's about planning ahead and maximizing your profit. If you're planning to sell an investment property or even options, consider speaking with a tax advisor to make the most of these rules. If you found this video helpful, please give it a thumbs up and subscribe for more financial insights. Thank you for watching, and I'll see you in the next video.